What is LTV in property? LTV stands for loan to value, and it is the ratio that a bank is willing to lend. So for example, a 75% LTV will mean that a bank is giving you a mortgage or loan that is 75% of the valuation of the property. Typically, for property investors or buy-to-let landlords, the type of mortgage available to us will be usually between 70 to 75% LTV. For a property that is valued at £100,000, and if the bank decides to give you a 75% LTV, that means you will receive a mortgage of £75,000 from the bank, and us as the borrower will need to put down 25% deposit equivalent to £25,000. For homeowners looking to buy a house for themselves, mortgages available to them could be at 90% LTV or sometimes even up to 100% LTV. That means they could put down 10% of the property value as deposit or nothing at all. Loan to value and equity. The lower your LTV, the more your equity in a property. Having higher equity can help protect you from negative equity. The value of a house can go up and down according to market conditions. If the bank gives you a 100% LTV mortgage and the property value falls by 10%, you now own a property that is now worth less than what you have borrowed. You won't be able to repay the full loan upon selling. This is negative equity. Loan to value and interest rates. The lower the LTV, generally the lower the interest rates. Banks would prefer if you have a decent amount of equity to put into property. They'll see you as being at a lower risk of missing repayments, which means you might benefit from a lower interest rate on your mortgage. For example, you'll tend to get lower rates on homeowner mortgages with 90% LTV compared to 95% LTV. Similarly, lower rates on buy-to-let mortgages with 70% LTV than a 75% LTV. At the end of the day, when we are doing our numbers as investors, it is important to know the LTV of property that we can get from a bank because that will affect the deposit amount and the interest rates. This helps with our financial planning as we build our property portfolio.